All right, let's talk about investing. Specifically, let's talk about index funds and ETFs. Because if you've ever felt like the world of finance is just way too complicated, this one's for you. We're going to make this simple.
Yeah? Does this look familiar? It's that heart attack chart, the one you stare at trying to guess what it's going to do next. Buying the dip, selling the highs. It's so stressful, right? It's this high-stakes game that, let's be honest, most of us just aren't equipped to win.
Oh yeah, I've been there. I'll admit it, a buddy gave me this can't-miss tip on some tech stock. It was going to be the next big thing. It was going to change the world. And you know what? It was so hot that my money just, boof, evaporated. That was my expensive lesson. Trying to outsmart the market is a recipe for disaster.
So if playing financial whack-a-mole isn't the answer, what is? What's plan B? Well, it turns out there's a ridiculously simple and kind of boring strategy that actually crushes most of those high-flying stock pickers year after year.
It all starts right here with something called an index fund. Now, don't let the jargon scare you off. All it means is that instead of trying to find that one winning lottery ticket of a company, you buy a fund that owns a tiny slice of all the big ones, like the 500 biggest companies in the US, which you've probably heard of as the S&P 500.
Here's the absolute best way to picture it. Imagine an all-you-can-eat financial buffet. Trying to pick individual stocks is like trying to guess which one dish is the absolute best. You might get lucky, or you might end up with a plate of lukewarm mystery meat. With an index fund, you're not picking just one dish. Nope. You buy the whole buffet. You own a piece of everything in the kitchen. Simple as that.
Now, you're going to hear the terms ETF and mutual fund thrown around. They're just two different ways to order from our buffet. An ETF is like the drive-thru. It's quick, you can place your order anytime the market's open, and the price changes constantly. A mutual fund, that's more like a sit-down dinner. You put your order in, but the price isn't set until after the market closes for the day. Honestly, for most people, the ETF drive-thru is perfect.
Okay, so indexing is simple, it's diversified. But there is another massive reason why it's such a winner, and it's something that quietly sucks away your future wealth without you even noticing. I'm talking about fees, the silent assassin of your portfolio.
So you might look at a fund in CFE, or what they call an expense ratio, and it's some tiny number like this, 0.68%. And you think, phew, that's less than 1%, who cares? That is exactly what they want you to think. But that tiny, innocent-looking percentage, it's like a termite, just silently chewing away at your returns year after year after year. Over a few decades, the damage is absolutely unreal.
You know, I've got a little dad joke for you. The only thing in life that grows more relentlessly and faster than the weeds in my lawn is investment fees. Because they compound, just like your money is supposed to, except they're compounding for someone else.
Let's put this in perspective. For every $10,000 you have invested, a super cheap S&P 500 ETF like VOO might cost you about $3 a year. 3. Meanwhile, the industry average fund, that'll cost you around $44. Now that might not sound like a lot today, but multiply that difference over 30 or 40 years, you're talking about a car, a down payment, a real fortune.
Okay, I can hear the big question already. Sure, they cost more, but I'm paying for a genius, a pro who can beat the boring old average and make me way more money, right? It's a great theory, but what does the actual data say?
Let's not guess. Let's go straight to the official scorekeeper. This is the Spiva report. It's put out by the same people who literally create the S&P 500. For years, they've been tracking one thing. Do the pros actually beat the market they're paid to beat?
And the results are, well, they're not pretty. Over any long period of time, say 10, 15 years, about 90% of professional fund managers fail to beat their own index. Let that sink in. 9 out of 10 times, you're paying extra for someone who does worse than the simple cheap Buffett.
The verdict is in, and it's not even close. Boring wins. It's not a fad, it's not a cute idea. Simple, low-cost index investing is just the mathematically smarter way to go for the long haul.
All right, you're in. You're ready to embrace the wonderful wealth-building power of boring. So how do you actually get started? Let's build a dead simple starter pack. You can build an amazingly powerful portfolio with just 1 or 2 funds. I'm serious. For your base, your main course, you pick one big, broad fund. Something like VTI buys you the entire US stock market, or VO, which gets you the 500 biggest and most influential companies. That's your foundation.
Then, if you want a little extra kick, a little more growth potential, you can add a pinch of something like QQQM, which is full of those big innovative tech companies. That's it, you're done.
So if you forget everything else from today, just remember this one thing. The whole philosophy comes down to this. Stop wasting your time and your sanity hunting for that one magic needle. Just buy the whole haystack.